Hello and welcome to our conversation on accounting. And today the topic of the conversation is deferred tax liabilities, and deferred tax asset. And the relevant accounting standard is Ind AS 12 relating to the income tax. So the important terms defined by the standard is the accounting profit, taxable profit. The accounting profit is a profit determined for the purpose of reporting to the shareholders. And the accounting profit is determined by using the principles of the reporting and the relevant accounting standards. Whereas the taxable profit is a profit determined in accordance with the rules established by the income tax or taxation authorities, and on which the taxes are levied, calculated, and that tax is payable by the SC. And we know that in most of the cases, in most of the situations, the accounting profit will not be equal to taxable profit, because the deductions, the expenses, the benefits, the incentives given under the taxable tax calculation or the calculation of taxable profit may be completely different from the expenses recognized and recorded for the purpose of reporting to the shareholders. So generally, the accounting profit will not be equal to tax profit. And this accounting standard talks about or gives suggestions how to deal with the difference between the accounting profit and the tax profit. So as a result, three important terms comes into picture. One is the tax expense. The tax expense is the summation of the current tax and the deferred tax. Because the accounting profit and taxable profit are not same, the concept of the deferred tax is brought into picture. So let us first understand what are these two terms, current tax and deferred tax. Current tax is the amount of tax payable, if it is recoverable because you might have paid more, in respect of the taxable profit calculated as per the income tax. And the deferred tax is arises because of the changes in the deferred tax liabilities and deferred tax expenses. So therefore, the tax that we see in the income statement reported by the companies to the shareholders will have two components. One is the current tax, the other is the deferred tax. So current tax is the tax on the taxable profit, where the deferred tax is the difference, the change in the DTL or DTA. Now we will understand that as we move along. So therefore, DTL and DTA are the other two important terms defined by the accounting standard. The deferred tax liabilities, as the name itself suggests, is an amount of tax payable in future which arises due to the temporary differences. Remember the term temporary differences, we'll elaborate that as we move along. So deferred tax liability is the amount of tax payable in future periods because of the temporary differences. So as the relevant term, the other relevant term is a deferred tax asset, or the amount recoverable in future in respect of the temporary differences. Now you may ask a question, what are these temporary differences? The temporary differences are the causes for the difference between accounting profit and the tax profit, which arises due to the difference in the carrying amount of assets and liabilities due to the mismatch or due to the different methods of measurement of the assets and liabilities. So the temporary differences are the differences between, therefore, the carrying amount of an asset or carrying amount of a liability in the balance sheet and the tax base. So there are two terms here, carrying amount and the tax base. The carrying amount is the amount shown on the balance sheet of a company prepared for the purpose of reporting. Tax base is a result of the tax accounting, and it is the normally you don't see that when we see the annual report of a company. So tax base is the assets minus the allowed depreciations and amortizations, where the carrying amount is the asset minus the depreciations and amortizations as used for the accounting purpose. Now, so this temporary difference, to put it in a non-technical term, and the terms which are not used in the accounting standard, normally arises because of the different accounting policies that a company adopts. So this may be relating to assets, or this may be relating to liabilities. Now, if in case of assets, if the carrying cost or the carrying amount is greater than the tax base, and this happens if the depreciations and amortizations are not same in both the cases. If the carrying cost or the carrying amount is greater than the tax base, that will be called deferred tax liabilities. Because in the accounting, we have charged the carrying cost of the asset is high, means depreciations or amortizations are low. If depreciations and amortizations are low, the accounting profits are higher, whereas the tax profits are lower. So therefore, in future, for the purpose of accounting, the tax liability may be there because of the difference in the carrying cost of the assets. Similarly, the carrying cost of the asset or the carrying amount of the asset is less than the tax base, then we call it a deferred tax asset. Because here, the carrying cost of the asset is lower than the tax base, because the depreciation, for example, in taxation may be higher than the depreciation claimed in accounting. So therefore, the carrying cost in accounting is lower than the carrying cost. Similarly, the liabilities values also may be different. The carrying cost of liabilities, which is shown in the books, if it is greater than the tax base, we call it a deferred tax asset. And if the carrying cost of the liabilities is less than the carrying cost of the tax base, then it is called the deferred tax liability. In case the carrying cost is same as the tax base, carrying cost of assets same as the tax base of asset, carrying cost of liabilities same as the tax base of liabilities, then no deferred tax asset or no deferred tax liabilities. And that happens if I continue with the example of depreciation, if depreciation in both for taxation and the accounting are same, then the carrying cost of a plant, property, equipment will be same in both the cases. If it is same, then no deferred tax asset or deferred tax liabilities. Now, if deferred tax liability is there, the change in a deferred tax liability from one year to the other is a deferred tax. Increase in a deferred tax liability is a deferred tax expense, and decrease in deferred tax liability is a deferred tax income. And we'll see that in this example. An increase in deferred tax asset, that means it's an income. Increase in asset is considered to be an income. And decrease in deferred tax asset is an expense or negative income. So therefore, to go back to our previous definitions, so deferred tax is a concept created to enable the companies to bring in and report the difference between the accounting profit and the tax profit. Otherwise, the shareholders will not know this. So therefore, this is an additional information for the shareholders by the company, which conveys a message, hold on, the profit that you're seeing in the annual report is not the same profit for the purpose of tax calculation. So there is a difference, and that difference, due to the temporary reasons or timing reasons or the timing differences, which normally arises because of the accounting assumptions, is being reflected through deferred tax liability or deferred tax asset. And the difference, the change in DTL and DTA, is called deferred tax expense or deferred tax income. Now let us take an example to a numerical to see the effect of the deferred tax or effect of the temporary differences. For that, I've created a small exercise. We have a 4 years data. In year 1, the business was started and they purchased a plant, and the small one transaction with respect to the revenue and one transaction with respect to the expenses. Our focus here is the DTL or DTA and change in DTL and change in DTA. But let us do the entire exercise so that we can see the impact of DTL and DTA on the financial statement. So started business with 250,000. So therefore, capital of the company receives money, and this is an inflow, and this is the source, the capital, the money collected from the shareholders is 250,000. Okay, 250,000 is a source and is an inflow of cash. No income, no expense at this stage. Okay. Now, purchase plant on credit. So acquisition of asset, the plant. Okay. So at present, I'm not following the schedules of the Companies Act with respect to the format. So I'm entering the data on the balance sheet. So as and when the transaction arrives. Okay. And there is a corresponding liability. We call it, suppose, plant supplier. Okay. So the plant supplier is 400,000. No income, no expense. Acquisition of asset resulted in creation of a liability. Then purchase stock for cash. Okay. So you purchase stock or inventory 150,000. And on this date, the stock is available, not yet sold. So stock is an asset. Okay. Stock is an asset. Then entire stock sold. So first time we are now having an income. So sales is 650, and let us assume that the sales is for cash. Okay, let us assume that sales is for cash. And we know that whenever there will be a sales, as per the matching concept, there has to be cost of goods sold, and the cost of goods sold is the plant. Okay, is the plant. Is the stock purchase. The entire stock is sold. So as a result, the stock will become zero in the balance sheet. So let me recap. So the stock was purchased 150,000 for cash, and this stock is sold. This stock is sold immediately So therefore, the reduction of stock becomes an expense and the stock has become zero. Okay, the stock has become zero. You purchased stock of 150,000 and you sold stock of 150,000. The stock has become zero. Then all the stock sold and there is an operating expense. OPEX is an expense. We pay the OPEX. 15% is an expense of the sales. Okay, 15% of sales. And let us assume that you paid that expense too. So all transactions done except depreciation. Now depreciation, for the purpose of accounting, it says the company follows straight line method. Company follows straight line method and of 25%, okay, of 25% at on the cost. The cost is 400,000. So the depreciation in the year one is 200,000. So which will lead to the reduction in the value of the asset, the reduction in the value of the asset less accumulated depreciation. Now this brings us to calculation of accounting profit or PBT. So the PBT is equal to the income minus the all expenses. So PBT is equal to PBT is 650 minus, right? So you see this, PBT is equal to 650 minus the expenses. So 302 is the profit before tax. Should we charge tax on this? So this is where the accounting standard 12 comes into picture. The accounting standard 12 says you have to find out the tax on the taxable income. So for that, in this example, let us do the taxable income too. So taxable income is only additional information which is given here, that depreciation for the purpose of tax is 63% using reducing balance method. All other expenses are same as for accounting. So therefore, we'll put all the items one by one. So sales 200, we could have done with adjustment at PBT, but it's always good to make show the income statement of depreciation of accounting as well as the taxation. Okay, and depreciation for the purpose of tax is equal to 63% of the asset cost, and the asset cost is 400,000. So depreciation is 250,000. Depreciation is 250,000. Now observe, if depreciation is 250,000, the summation of expenses for taxation is 497, and if the summation is 497, the taxable profit, is equal to TP is equal to 650 minus the allowable expense 152,000. And the accounting standard says if the PBT is not same as the taxable profit, you have to calculate CT and DT. So therefore, we will have current tax and deferred tax. So what is current tax? The current tax is tax on, let us assume the tax rate to be 2.5, that is 25%. So tax rate is 25%. I put it here, 25%. So tax is 32,000, 38,000, and you pay tax on you pay tax that is 38,000. Okay, so 38,125, 38,100. But what is this deferred tax? So if we strictly follow the letters of the accounting standard, we need to find the carrying value of the asset. The carrying value of the asset of books is cost minus the depreciation. What is the tax base of the asset? The tax base of the asset is the cost of the asset minus the depreciation in the depreciation as per the taxation. So which is 150,000. So the difference, the carrying cost, is greater than the tax base, and that we call it the timing difference, because depreciation at a point of time may be different, but depreciation over a period of time will be same in both the cases, because the depreciation is equal to the cost of the asset, which is 400,000 there. This will also become clear as we move along with the up to fourth year. So there is a deferred tax liability. So the deferred tax liability is the tax rate into the timing difference, and the timing difference is in the asset is the difference between the carrying cost and the tax base. Carrying cost is the cost shown by the balance sheet, and the tax base is the asset minus the allowed depreciation for the purpose of taxation. So DTL will be shown on the balance sheet. DTL because the carrying cost is higher than the tax base, as we just saw this. If the carrying cost of the asset is greater than the tax base, it's called DTL, because you are going to pay more tax in the later years. Okay? And since this is the first year, the change in the DTL previous year and the current year is called the deferred tax. So the DTL has gone up, assuming that opening DTL is 0, closing DTL is 37. So the deferred tax that you get here is 37,500. So PAT is equal to PBT minus the CT minus the deferred tax is the profit after tax. If no information is given, we always make an assumption that the entire profit is retained on the balance sheet. Okay? The entire profit is retained in the balance sheet. If no change in the stock, no change in any other liabilities like plant supplier, now we have transferred the entire profit after tax to the balance sheet. Now let us find the cash in hand. The cash in hand is equal to cash available minus the cash payments, minus the cash payment. So therefore, cash in hand is equal to cash available minus the cash payment, and cash in hand is an asset, right? Cash in hand is an asset, and asset will be shown as 614,300. So our balance sheet tallies. But a focus of this particular year's exercise, year of this, is the deferred tax liability and deferred tax. And the deferred tax liability is actually arising because of the timing difference, because of the timing difference. And the timing difference here is the difference between the carrying cost of the asset, which is property, plant, equipment, minus the tax base, because there is no other item where there is a difference. Now, to get a better picture, Let us see for year 2, year 3, year 4. For the purpose of explaining only the deferred tax, we kept the other transactions to be more or less same. Okay. So let me unhide, remove open the other years template. Okay. So that we can do it together. Unhide. Right. Now, in year 2, the every year we are purchasing 150,000. Okay, we are purchasing 150,000 stock, and we are making the payment of 150,000. Okay, so I'm doing that for all 4 years at the same time. And stock purchase is immediately used, so therefore the stock purchase is sold in the year of purchase itself, and that is becoming COGS. And as a result, the stock is zero throughout the 4 years of observation. And all these years, the sales is 650,000, which is collected all the 4 years immediately. Okay, so the sales is cash sales, and entire stock purchase is sold. So therefore, there is no stock at the end of the year, and the entire stock is becoming the COGS. The OPEX of the company is same 97,000, and we assume that the OPEX is paid all 4 years. Now the depreciation in all these 4 years is 100,000. We can see that because depreciation is charged on the original cost at 25%. Okay, the depreciation is charged on the original cost 400,000. So in all 4 years, the original cost is 400%, and depreciation is charged at the rate of 25%, right? At the rate of 25%. So 25%, we'll put this as fixed so that we'll not have any problem later. So therefore, depreciation is 100,000 for each year. As a result, the accumulated depreciation year after year increases by the depreciation for the year. So depreciation is 100,000, accumulated depreciation goes on increasing. So we can see that the carrying cost of the asset, is falling to the extent of depreciation. For the timing, we assume no impairments, no revaluations. So can you see the carrying cost? So the carrying cost of the asset is 300,000, 200,000, 100,000, and 0. Year 1, year 2, year 3, and year 4. So the carrying cost is reducing because of the depreciation. And carrying cost or carrying value is as per the balance sheet of the company. Now let us see the tax statement, okay? Because now we have to calculate the tax. So let us first find PBT, because the incomes and expenses are same. The PBT for all the 4 years will be same. Now what is the taxable profit? The sales is same. COGS is same. OPEX is same. But depreciation is not same. So what is the depreciation in year 2? It is 400,000, right? 400,000 minus 200,000, 250,000 into the depreciation for taxation. Okay, depreciation for tax. And depreciation for tax, okay, so let me put that once again. So depreciation for tax is equal to 400 minus the last year's depreciation into rate, because the depreciation will be charged on the, okay, 240 43,000 for the purpose of taxation. So depreciation is equal to, oh, again I put the formula wrong. So 400,000 minus 250,000 into the tax rate, right? So 93,000 is the depreciation. Can we see that again? 400,000 minus 250,000 into 63,000. Okay. So in the third year, 400,000 minus 250,000 minus 93,000 into the tax rate, 63. So depreciation is 35,156. And let us assume that we also want to close, make the life to be no written down value after fourth year. So whatever balance is available, we charge in this year. So 400,000 minus 250,000 minus 93,000 minus will be the depreciation. Okay, so yes, so depreciation in the fourth year. Now observe, the depreciation in the books of accounting in the income statement is 400,000. Observe here is 400,000. And depreciation in taxation is also 400,000. So that means the total depreciation claimed in accounting books for the purpose of reporting and the depreciation for the purpose of tax is same. However, depreciation at each year is different. So depreciation over a period of time is same, but depreciation at a point of time is different, which results in the creation of a temporary difference. And that temporary difference creates DTL. And that's what we are going to see now. So let us see the tax base. The tax base is equal to, tax base is 400,000 minus 250,000, right? 250,000. The tax base is equal to 400,000 minus 250 minus depreciation of the current year, 56,000. Is that okay? So depreciation. Now, for the third year, is 400,000 minus 150,000, right? Oh, that's the tax base. So we can use directly. So tax base minus depreciation. So that is 21,000, and 21,000 minus 21,000 is 0. So you see the tax base by the end of the fourth year is same as the carrying cost of the asset in accounting. But each year, all through these 4 years, it is not same. The carrying cost of the plant is throughout these 4 years is higher than the tax base of the asset. Since the carrying cost is higher than the tax base, in all the 4 years, we are having, all 3 years, we have deferred tax liability. So deferred tax liability will appear on the balance sheet as 35,000, 37,000, 35,000, and 19,700. And observe this, the change in the deferred tax liability is considered, the change in the deferred tax liability is considered as an asset or a liability. In this case, because deferred tax liability is decreasing, we call that as a deferred tax income. If the deferred tax liability goes up, it's a deferred tax expense. So therefore, in the subsequent years, the current tax is computed on the taxable income. Okay, the taxable, let us find that first. So the taxable profit is equal to 300, taxable profit 308, accounting profit is 302. The taxable profit is 367, accounting profit is 302. Taxable profit is 381, accounting profit is 302. So therefore, the current tax is calculated on the taxable profit is calculated on the taxable profit, and the difference or the deferred tax arises because of the difference between the difference between the carrying cost of the asset and the tax base of the assets. And the carrying cost of the asset and the carrying cost and the tax base leads to the timing difference, and the timing difference leads to DTL in this example. So we'll see the profit before tax minus CT minus DT is equal to deferred is equal to PAT. If no information is given about the distribution of dividend, we just add the profit to the retained profit and keep on increasing the balance sheet. No change in the capital, right? No change in the capital. The capital remains same all 4 years, no issue, no buyback, no redemption. So therefore, the capital is same. The retained profit increases because of the PAT. The plant supplier, we did not pay off the money, so the plant supplier will continue to stay on the balance sheet as a liability. And the DTL, as I mentioned, this is on the timing difference, and over a period of time, the timing difference nullifies the deferred tax asset or a liability, and DTL slowly becoming zero because of the timing difference. Let us see the sources side, the asset side of the balance sheet. The asset side of the balance sheet will have plant, and the value of the plant keeps on falling because of the current depreciation, and the current depreciation is the SLM. So by the end of the 4th year, the carrying cost is equal to 0. As we have already seen, the stock has been throughout the 0 because whatever we purchase is sold off. But cash in hand is there throughout, right? So the cash in hand will be equal to cash available minus the cash payments. And the cash available during the year is equal to, okay, so 19, so it is cash available every year 1.2 million minus 3.2 is equal to the cash available is 939. Then we will have cash available is equal to 1.2 million and 1.5 million. And the cash available is a balance sheet item, is an asset. So therefore, we can see the asset side of the balance sheet tallies with the sources side of the balance sheet. But our focus was not the entire exercise of preparing the financial statement. Our focus was to understand how the treatment of the difference between the taxable profit and the accounting profit. The taxable profit in this case is different from the accounting profit, which is PBT, because of depreciation, which is a timing difference. And this timing difference creates a difference in the carrying value of the asset, carrying value of the plant, and the tax base of the plant. and the tax base is the value of the plant minus the depreciation allowed for the taxation. And depreciation for purpose of tax is 63% RBM, and for accounting, it is 25% SLM. We assume the life to be 4 years. So by the end of the plant 4 years, the carrying cost to the plant and the tax base becomes 0. But all through 4 years, CC is greater than the tax base. When CC is greater than the tax base, we know that there will be a deferred tax liability, and this deferred tax liability will be shown on the balance sheet, and the change in the deferred tax liability will be shown on the income statement as an expense or an income. In this case, there is a fall in the DTL, so we are showing as a negative deferred tax, or it can be called as a deferred tax income. But suppose if the tax is not paid, the current tax is not paid. Suppose in the fourth year, we decide not to pay the current tax, okay? Suppose we don't pay the current tax in the fourth year, okay? Just to understand the difference, if we don't pay current tax, so there'll be an expense, no doubt, 95,000, but there will be no payment of the tax. Which tax? The current tax. If we don't pay the current tax, then we show the current tax payable as an expense, sorry, as a liability. Sorry for that. So the liability will be expense minus the payment. Expense minus the payment. So if the tax is not paid, that is a liability, and the liability will be shown on the balance sheet, and normally current tax payable is a current liability. Now you may ask a question, or rather you should reflect, what is the difference between current tax payable and deferred tax liability? Current tax payable is an actual liability that the company is bound to pay. If the business is closed in the fourth year, suppose, if the assets are sold off, the money received will be used to pay the 95,000 current tax, to pay off the plant supplier, and whatever money left will be given to the shareholders. The company is not required to pay DTL, if any. Okay. Suppose instead of fourth year, suppose I say that it has not been paid in the, okay, so you see, so DTL is 0. And if I don't pay here, okay, in the third year, okay, in the third year, so in that case, the current tax liability will be 91,000 minus 0. So there will be a current tax liability in the books of the company, and that too it will be shown as a current liability. So if the business is closed at the end of the third year and the company collects money, they have to pay plant supplier, they have to pay current tax payable. Even if DTL is visible on the balance sheet, the company is not required to pay this 19,727 to the tax authority, because this is a book entry. This is a notional tax. So often a question is being asked or comes to mind, is DTL a liability in a strict sense? Okay, though the Companies Act, though the Schedule 6 and 3 stores says that the DTL should be shown on the balance sheet as a long-term liability separate line item. But it is worth reflecting upon, that is DTL same as the current tax payable? Is DTL same as other liabilities like plant suppliers, loans, bonds? Because this is created to reflect, to show the difference between accounting profit and tax profit arising out of the temporary differences. I think I'll stop here. So the objective of this session was actually to explain briefly the different vocabulary, different terms defined under the Ind AS 12 with a focus on DT, DTL, and DTA. In the process, we observed something called temporary differences, which leads to DTL, and the change in the DTL is the deferred tax expense or a liability, and the DTL is not same as the current tax payable because it's a book entry. Okay, I'll stop there. So thank you very much.